Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
Mr. Sandman.
You get the idea?
Bring me a dream.
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
and tell him that his lonesome
Here's the
nights
Sandman.
are over, Sandman.
The market landscape has changed, and now that the number of publicly listed firms has declined about 40% over the last 25 years, people are wondering, where should I be investing right now? Whether it's Trump 2.0, legislation, taxes, what are you going to do? Well, it's all coming this morning as we talk about where should you be investing right now. Good morning. I'm David Hollander. I'm your host. People around here call me the Sandman. You hear the jingle. Well, that's because I help you protect and keep more of your money. Been doing it for almost over 30 years. Wow, I can't believe it. Time goes by so fast. Ask me a question anytime. I love the emails. Thank you. Had a good one this week. Can't wait to share with you. You can email me your question to questions@PYA Radio. Stands for Protect Your Assets Radio. PYARadio.com. I'd love it. Thank you. All right. So shifts in the market. What happened this past week? What's going on? Why is it going down? The Magnificent Seven isn't working anymore. So with policies changing, with who knows what's going to happen in Washington, and now when you look at the number of publicly listed firms, this is things that trade on the market. It's declined 40% over the last 25 years, meaning there's a lot less to choose from. There's a lot more money floating around trying to find it. I don't know about you, but that was basic economics. So what can you invest in? What else is out there that could make some sense? That's what we're going to talk about today, give you some other alternatives, things you can think about, as this year promises to be exciting. Keep it right here if you want to hear what's on my mind. Now, let's get started. Well, last week, the S&P 500 gave up most of this year's gains. In fact, went below last year's closing price, finished the week down 1%. Year to date, we're slightly up over 1%. The Dow is up 1% for the week, year-to-date up 3%. So there's an example right there. You have the Dow Jones year-to-date beating the S&P 500. First time in a long time that's happened. And you may wonder why. We'll talk about that. NASDAQ this week, more of the same, down 3.5%. Yeah. It's not working anymore, is it? MSCI EAFE off a little bit, but year to date, look at this. International indexed up 8%. And that's not over yet. 10-year treasuries, 4.21. So the 10 years come down quite a bit. 4.21% off this week, 0.2%. Oil, that's another story. Oil held up at $70 a barrel, 70.09 to be exact, off for the week, 0.4. Year to date, oil's off 2.3%. And bonds this week, well, price went up a little bit, yield went down, so we're up right now week 1.3%. Year to date, bonds up 2.3%. So over the past 2 years, the Magnificent Seven, there's some of you out there who own some of those, don't you? There's a whole lot of you, actually. And this past week, we had someone come in who owned a lot of that and has done really well the last 3 years and just felt like a superhero. And now he's wondering, how does he turn that into income that'll last the next 30 years of his life, because he's in his late 50s, not working anymore and wants to live off of that money, but doesn't know what to do. And he's seeing that since these Magnificent Seven have entered correction territory, some of these are off over 20% year to date. It's a big move. The tide is changing. It's shifted. And I talked about this back in December. Go back and listen. Those of you who are with us, you know what I did. The group has shifted. The tide has changed. And that Magnificent Seven that was a leader for a long time has become a laggard. and they're now chasing what's going on. So why are investors worried right now? What's going on specifically with tech and Wall Street? Let's start out with that. There's 4 reasons I'm going to identify. And the first has to do with tariffs, of course. We've heard about this for a while. Everybody wants to know, what does it really mean? Well, the simple fact remains that we just don't know. How deep is this going to be? What's the size of these tariffs? How is it going to impact our relationships with Canada, Mexico, the EU, and anybody else who pops up? Because this is a reciprocal tariff environment that we're in right now. This is something that Trump is trying to model what happened in the 1800s. Go back and look at McKinley and what he did and where the money came from. It's a model. This is literally what's going on right now. If you hit us with this, we're going to hit you with that. We're going to collect a bunch of money in a big pot, and we're going to have a bunch of money here. We're going to get out of debt. I mean, this is the story. I'm not making this up. Go read about it. So that's unknown. When you have an unknown, look, I'm talking market today, not politics. This is about the market. And when the market doesn't know what's going to come or happen, it doesn't like it. And that's what makes them nervous. That's number 1. Number 2, federal workers. Well, I don't say I'm loving Dodge, but I love the word Doge, right? D-O-G-E. It's like become a new verb. You've been doged. Got to come up with that, Kevin. Let's come up with a rhyme. Yeah, you've been doged. This is unbelievable. Firing of federal workers. People have been working forever. These people don't make a ton of money, but you're gone. You're doged. What'd you do last week? 2 million plus federal workers, as well as companies who hire thousands of contracted employees to fulfill their federal contracts. This tightening their financial belts is uncertain. What's going to happen? But the bottom line, 2 million federal employees is a little over 1% of the entire U.S. workforce. 1%. So they can't really directly cause economic slowdown in itself, but it's an unknown, and that can affect corporate earnings. And when there's unknowns, and again, you see the theme developing, there's that. Third, let's talk about the Republican Party that was so united and they were just going to pass things through. We saw what happened last week. Okay, they passed it, but what happened behind the back room? We don't know. We haven't seen it yet. So, more unknown. And the last one, my favorite, what I talk about all the time, taxes. Any extension coming on the Tax Cuts and Jobs Act? Question mark. That's a big one. And it's unknown. So think about it. Let's just put the pause button. Let's think about 2025. We all expected running into this year that the Republican-controlled government was going to be pro-business, pro-growth policy machine. But so far, has that happened? This is a near term, talking short term right now, negative on the market. And that causes what we just saw this past week. So once we get clarity on these issues, those are going to start to remove those headwinds that are preventing the market from moving ahead. And I'm not saying these are permanent negatives because I don't think they are. And I've been doing this for a while. My experience has taught me that when one party has control, they very seldom willingly, kind of like we saw last week, do things to impact growth. So despite these early issues that we've identified this morning, it's still right to view the current government as pro-growth and likely positive for stocks. And this morning, we're going to talk about other financial assets. So what should you be thinking about right now? What should you be investing in today? That is the topic of the show. What else is out there that might work in this environment? If you want to find out, you keep it right here when we come back. because I have much more for you today as I'm so excited to be back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman. And you are listening to Protect Your Assets this morning. People, they call me the Sandman. That's because I help you keep more of your money. So if you're just joining us, the market landscape has changed. Can you feel it? The S&P 500 pulled back this week. The NASDAQ got hit again. And people are wondering what's going to happen with all the changes happening right now with Doge, with the tariffs, with the tax laws. What does this mean? Where can we invest? Where can we make money on our money? That's the theme of today's show. We're going to cover some ideas that might help you do better this year when things are so uncertain. So the first thing I want to talk about is something called alternatives. Now, this is a big subject. We have a nice handout to give you if you'd like it. But I want to backdrop for you what this means. First of all, over the last 25 years, when you think about the stock market, the number of firms that publicly trade on that market has dropped almost 40% over the last 25 years. So think about that. If you're losing the amount of number that you could invest in because of consolidations, et cetera, and there's more people now investing and chasing the returns, well, what happens to those things? They become overvalued. And then you have to start looking for other things to do. So the first thing to talk about before we get into alternatives, I'm going to talk about some traditional things right now that typically work when you've got a Trump 2.0, frankly. And so there's 4 strategies that you might want to think about that could help you. And the first, which I alluded to before the break, is Europe. For the first time in years, the European stocks right now, as I mentioned, that's the EFI index I was talking about, was up year to date over 8%, and they're handily outperforming U.S. stocks. So while Europe is susceptible, of course, to tariffs, they're not undergoing the policy chaos right now, thanks to Doge, government funding extensions, debt ceiling limits, tax cuts. All that stuff's not happening in Europe right now. Plus, you've got the ECB, that's the equivalent of the Fed. They're not close to pausing rates at all. In fact, they're being very transparent of what they're doing. So that helps stocks. Remember, as rates go down, stocks like that, they typically go the other direction. So you have policy on your side. Third, Europe's stocks are trading right now at much lower valuations, even with this appreciation, than the S&P. For instance, 15 times forward earnings compared to 21% for the S&P 500. Now, so that's one area to think about if you don't have any exposure there. Second area you might want to look at called defensive sectors. Like what? Well, healthcare, consumer staples, real estate. Check them out. Why do you need those? Well, because you got to live somewhere. You got to pay rent. You got to pay your mortgage. You got to brush your teeth. You got to go see the doctor when you mess yourself up like I did. I'll be talking about that at some point. But anyway, you got to pay for these things, and they're expensive. So whether you like it or not, they pay dividends, and they do okay, and they're doing okay right now. What's the third strategy? Well, this has been interesting. Long-term bonds. Why? Well, before all this started happening right now, people were worried about the fiscal imbalance and the runaway spending of the government. And those are fading right now. They're not gone, like I've been saying, but instead of the chaos and the uncertainty, some of this stuff, the turnaround, is helping long-term bonds. Why? Well, Doge is at least have some reflection of reduced spending. And you've got increased government income that should come in from tariffs, and the inability for Republicans to coalesce around a tax cut strategy. So more dramatic future fiscal deterioration. So if we see an economic slowdown, which, by the way, some people are talking about the recession word. So those are a couple areas you could take a look at if you're thinking about where should I be investing some of my equity money that right now. And this came up this past week because we had a gentleman who came in who had been investing the Magnificent Seven for years and done really well. And if you own the S&P 500, you own a big chunk of that because you know it's a big percentage of that. And so now you're wondering, well, what do I do when it's not working anymore? I'm losing money. That's when you got to shift. You got to do some other things. You need some professional help maybe. You know, we've seen these things before. So what do you do? Well, you can pick up the phone and call us. 866-PROTECT. It's one way to do it. What are alternatives, by the way? Let's talk about that. We'll get started here on that. This is an area where traditionally those who had the big bucks, like the pension plans, the insurance companies, endowments, institutions, lots of money to invest, hundreds of millions of dollars to invest. They typically will invest in alternatives. And so this is an area over time that has become interesting because there's a lot of choice. So when I come back, we're going to talk about our They Say segment. In that They Say segment, we're going to talk about our alternatives only for institutions, meaning not you. Or there are other ways for you to get involved in alts now as a way to hedge or take advantage of other areas that you just didn't even know existed. That might work in this environment that we're in. Find out more about this. You don't want to miss it because there is some other ideas out there. You're listening to Protect Your Assets with me, David Hollander. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAEvents.com and signing up for our next free event. That's PYAEvents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman around here. And you are listening to Protect Your Assets this morning. And this past week with the markets falling down and people wondering what you should invest in with Doge and Trump. And wow, that was something with Ukraine this week, wasn't it? Gee whiz. So anyway, with all this going on, the markets are not feeling real good. And there's some areas that just aren't doing so well. And so what does the future look like? Where should you be investing? That is the topic for today as this landscape has changed quite dramatically, and we're wondering what to do. All right, so this morning we're talking about what are some areas you could be investing in now that the tide has changed. So let's do this. Now it's time for one of our fan favorite parts of the show. It's our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All I know is that I don't.
All right, so here's one they say. They say that in order to get into alternatives, you need to have over $5 million to invest. Is that always true? No, it's not, actually. Let's talk about it. So alternatives have actually become a, I'll call it more mainstream place to invest. And right now, with things becoming uncertain in the last few years, if you look at total return and some surveys I'm about to talk about here, alternatives are interesting. So write down the word alternatives so you could check it out. Now, let me educate you a little bit. At a very high level, again, this is high level. This is the radio. We're just talking about concepts and ideas. You need to do your homework here, and please spend some time on it. Don't just throw your money around wildly. At a high level, Alternatives can be placed into the two following buckets. I'm going to call it the private markets. And this is what's interesting for most that didn't know about this. Liquid alternatives. So private markets consist of three asset classes. Again, write these down. Private equity, which a lot of us heard about. What's private equity? Some people, oh, these guys throw around money at ideas. That's close. Private credit and private real assets. Notice I said real. Those are physical. It's not just real estate. All kinds of things that go with that are worth some money these days. Like a public stock or a bond that trades that you're familiar with, that you might own in your mutual fund, where investments represent ownership in these public companies that trade, or a loan like a bond to a public company. Private equity, private credit generally provides cash ownership interest in these things that aren't publicly traded. So that's why it's called an alternative. This is outside the domain of public markets. Private real asset investments, they typically represent ownership in these physical assets, like maybe you hold title on something. Infrastructure could be a commodity, like oil and gas. All right? Or maybe you own a contract in something. Historically, private markets have generally outperformed similarly traded assets in public markets. Really, according to who? Well, as depicted in a couple surveys that are out there. Check this out. There's data from MSCI Burgess that has measured annualized returns for public versus, again, alts since 2005. There is also a Fidelity study that's done recently where they analyze returns on private markets that is available right now. And when you look at these statistics, the takeaway, what you need to think about right now, when you're wondering what else is out there, is that liquid alternatives, this is where the local guy like me and you, we don't have to have $5 million. We might be able to get involved in something like this. And this could offer, in fact, according to these studies, it gives you more diversification, gives you less risk if it's correlated properly to what you're trying to do. And you potentially, again, how you do this, we'll study a couple cases here, could give you better returns. So if you're taking less risk, getting more diversification, getting better returns, what's wrong with that? Oh, and I forgot, it could provide downside protection. Does that sound good right now? Want to protect your assets right now? I do. So this study that I'm more than happy to share with you this morning can be yours. All you have to do is pick up the phone and call us, and we'll share it with you. Now, let's get more into some alternatives. They've evolved from a small segment that was really only for the institutional investor or sophisticated people. It's become mainstream. This is now a mainstream asset class backed by large sponsors and a diversified investor base. So check these numbers out. In 2005, about $4 trillion in global assets were allocated to alts. By the end of 22, alts made up $20 trillion. So 4 to 20. Over the last 25 years, again, because we've had a decline in publicly traded companies, the investments have grown substantially in this alt market as an alternative to making money. So that's why you've heard a lot about private equity. I know a lot of you probably heard about it, and you always wonder what is it and how do they get involved and how they make money. This is partly a piece of what I'm talking about. So despite the growth in alternatives, investors now are allocating more to this. Let's look at the numbers right now. This is where this comes in. This is where you may have heard they say, right? We were talking about earlier. The alternatives right now in this space today, as far as advisors, this is we retail, makes about 6% of that market. When you look at the publicly traded market, 62% is made up by AUM or the retail investor. So think about that. If you're investing in public markets right now, it's 62%. Whereas if you're investing in alternatives as a regular investor, you're only 6%. See the difference? Huge. as we look out, alternatives right now, when you're talking about an institutional investor, 23% of the market is made up by institutions. So that's where you're getting that from. Pensions, another 23%. Insurance companies, another 17%. Endowments and foundations, 32%. Compared to the public market. So again, less public when it comes to these institutions, pensions, insurers, endowments, more retail. And when you look at alternatives, it's more the other way around. And that's why there's been this, I guess, understanding for so long. And maybe you never even heard about it. Why? Because your advisors weren't talking about it. They didn't know if it was available. And if they did, it was maybe a private illiquid type deal that you'd hear about here and there. And that was about it. So that's the landscape. That's why this has developed the way that it has. So how do you select the appropriate alternative for you, for your portfolio? Well, this is important. This requires a review with your advisor who knows about the subject, about what your objectives are. How much risk can you tolerate? Could you really tolerate losing all your money or a big part of it? And this is super important. What are your liquidity needs? And this is where this gets very difficult, because when you switch from working to retirement, you want consistent income that you can live on for the rest of your life. You want that check to hit your bank every month, no matter what's going on in the market. That's very important. So you got to build this right. So that's something you need to talk about. Second, it really depends on your situation. This is so unique. It really is. And so the investment experience, your sophistication, your time horizon, what kind of withdrawal needs you have. Are you covered from a fire? What if there was a problem with your property and now you need some capital to rebuild that or change that situation? What do your liabilities look like? Do you have enough emergency funds? I mean, these are things that you have to talk about and be on top of. And if you're not, you're ready for a problem. Because when the problem hits and you're stuck, what are you going to do? Don't find out when it's too late. Get prepared, get in front of it, be ready. So when it happens, you're ready. That's all I can tell you. And we're going to offer you that right now. You can get the guide from Fidelity right here. Call us right now. We're sitting here ready to talk to you. 866-PROTECT. Get your free copy right now. 866-PROTECT. Now, coming up next, we're going to look at a couple examples. So maybe you could see yourself in the situation and how you might use this. It's all coming up next. We'll be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com, where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman. And you are listening this morning to Protect Your Assets. And the investment landscape has changed. We felt it pretty big this past week with the S&P pulling back, actually getting below where it closed last year. Finished up a little bit, but still, it was a little bit of a shakeup. And now that the Magnificent Seven is no longer performing, you're probably wondering what to do. If you're at or near retirement, you're thinking about these questions right now, then you need to get some help, because this is definitely a different environment. Things are changing. And if you're positioned properly, this really shouldn't be affecting you too badly. So moving on, let's talk about where you could be investing. So if you missed the previous segment, we've been talking about the change in the market that's occurred, the landscape, Doge, Trump, taxes. It's all coming at us. What do you do? Where do you invest? What do you do? Okay, well, right now we've talked today about a couple ideas. If you missed it, go check out our podcast. But let me give you some examples of investors with different needs and how and all might fit into the situation. Let's talk about a persona of number one, who is an investor with high liquidity needs. And let's say they have 500,000 excluding their primary residence to invest, has a long time horizon, they're sophisticated, has high risk tolerance, but they may need some cash, pretty high level of liquidity. Let me give you an example. This particular person who may be, say, in her low 30s. Maybe she was investing 80 equity, 20 fixed income traditionally. Well, she could do the following. She could do 79% in equity, so a little less equity, 15% fixed income, and then perhaps drop 6% in alts, but most likely liquid alts as opposed to illiquid alts. If you missed my discussion on that earlier, go back and listen. How about this person? He is 62 years old. He's an accredited investor. That means that he has over $1 million liquid. In this case, he has $3 million liquid, excluding his residence. His time horizon's midterm because he's going to live probably another 25 to 30 years. He's sophisticated, has a moderate risk tolerance, and he has 6 months of emergency capital. And he likes to make around 6% a year. He doesn't need a lot of cash right now. As long as he has his income covered, he's in good shape. So this person who is traditionally a 60-40, 60 fixed income at that point in life. Have you heard about that? If you're 60, you should put 60 in fixed income, 40 in stocks. That's another rule out there, depending on your age, how you invest. He's a 60 fixed income, 40% equity. Well, here's how he might use alts. Think about this. He might have 28% in equities, 49% in fixed income. So notice the difference there. The difference, 12% on equities, 11% on fixed income. Well, he might put 8% liquid alts, 15% private market illiquid. Again, we've got case studies to share with you where folks have been doing this, again, according to this research. How about the fourth investor? Again, an accredited investor, $3 million or more to invest, excluding primary residence. High risk tolerance. Doesn't really need any sort of cash right now. Let's say he's in his late 40s. He's an 80-20 once again, 80 equity, 20 fixed income. Well, maybe he drops that 80 equity down to 50. So that's a 30% change. Fixed income, 20% drops that to 15%, 5% change. You take that 35%, what do you do with it? Well, maybe in this guy's case, 5% go into liquid alts because he doesn't really need that, but it's there in case he does. Private market alts, 30%. But look at the numbers. This is all very interesting. These are the things that right now you need to be taking a look at. Because if you're not, you could be missing out. Because the tide is changing. There is a lot going on in this country right now, as you know. And when things change, you need to be in front of that. So take a look at the research we have. Take a look at the things that we've done here. We're more than happy to share with you and show you what we're doing to try and protect your assets from all this volatility and uncertainty that's out there right now. If you have questions, you haven't heard from your person for a while, you haven't seen any changes or trades going on in your portfolio, that's a sign. That's a sign that something could be wrong. And you don't know unless you know. And like I just saw two doctors, both very qualified, both top 80, low 90% in my opinion. And I went with someone who I felt was 90% plus, and I'm feeling pretty good right now. The guy did a great job. I'll tell you about him later. I may have him on the show here, but so far so good. So all I can tell you is that matters. Get those extra few percentage points. Make it a better experience. All you got to do is pick up the phone. It's a phone call. 866-PROTECT, the number to call right now to get your report. It's a great report talking about alts. Absolutely complimentary. Call us right now. 866-776-8328. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. My executive producer, network manager, Kevin Renfer. And, of course, all the folks back there doing the heavy lifting this morning. Got Raph, got Dylan, you got Nick. Thanks, guys. Because without my team, I'm just another pretty voice on the radio. Well, I'll thank my wife, Sheila, too. I wouldn't be here without her. You have been listening to the Protect Your Assets show. I'm David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.